So you wake up one day and it's just like any other day. You know, nothing to worry about. It's just a normal day. Maybe you look around and you see it's a nice day, so you decide to go outside, take a nice little walk to the mailbox, check your mail, because, you know, it's just like any other day. And you don't have any other worries about, especially financially, and especially about taxes, because you've been filing your taxes on time every year, and you've been receiving your refunds every year from the IRS and the state. So really, you just want to enjoy this day before, you know, you go to work. So you get to your mailbox, you check your mail, you get it out of there. And to your surprise, you see there's a letter from the IRS. And maybe your heart starts racing a little bit. Maybe they're just informing you that they owe you more money, because that could happen. So you get home, anxious to open the letter. You start to rip open the letter. You start to really rip open the letter. Just really rip it open. Yeah, there you go. And your heart just stops. Because what you see here is $285,000 of proposed taxes due to the IRS. Something, you know, makes no sense to you. Because you've been filing your taxes on time every year, because you've been receiving a refund every year, why the hell is this happening? Why do you owe so much money to the IRS? So you think to yourself, so the scenario I just described is pretty common. Now, a lot of times, the CP2000 notice is actually incorrect. Like, the IRS is wrong. But it's not because of some stupid clerical error. It's just that they don't have all the information. So they go off of the information that they have. The most common types of missing information is the missing cost basis. For example, if you sell a home and it's recorded on the 1099 and you don't record it properly on your tax return, then the IRS is going to think that you're going to owe way more taxes than you actually do. Or another common scenario is if you sell stock or you forget to report your stock sales on your tax return and the IRS doesn't have your cost of the stock that you purchased it at, then they're going to think you owe more taxes than you actually do. So those are the two common scenarios. Now, sometimes the IRS in this notice is correct. Like, sometimes people just forget to report their retirement withdrawals, or they forget to report certain things. And so the IRS issues this notice to propose changes to their tax return because the IRS does show that maybe you do have retirement withdrawals that you didn't report. And in that case, this notice would be correct. But I would always look at these notices with a fine-tooth comb, because you can't always just trust the IRS. And yeah, I mean, I'll take it a step further. You should never just blindly trust the IRS. You have to look into it. You have to dig deeper and see what's going on here. Okay? So you receive any kind of notice from the IRS, make sure you dig deeper, make sure you do some research, talk to your tax professional, call us up, whatever it is, find out more information, figure out what's going on, because there is a decent chance that they don't have all the information and they could be wrong. So in the example that I have here, we do have a real estate sale, a sale of a primary home that wasn't reported properly on the original tax return. And that's why the IRS sent this letter. So if you don't report it properly, but let's say the title company reported it to the IRS that you sold this home for $573,000, the IRS is going to think that you had a capital gain of $573,000. But the nature of capital gain is that it's your sales proceeds minus your cost of the home minus your expenses to sell the home. Okay, and some other things too, but just as a very basic formula, that's it. So if the IRS doesn't know how much you bought the home for, they're going to assume that you have a capital gains on the entire sales proceeds of the home. On top of that, if this is your primary home and you've been living in it for at least 2 of the last 5 years, then you can get a significant amount of the capital gains forgiven or excluded. So if you're single, that amount is $250,000. If you're married, that amount is $500,000. So in this case, we have a few problems here. First, the IRS doesn't know the cost basis of the home that the taxpayer bought it at. So the IRS doesn't know the cost basis. The IRS doesn't know that the taxpayer lived in it for at least 2 of the last 5 years, and they qualify for that capital gains exclusion. And so the IRS just thinks that they owe taxes on that giant amount of money. So what we did was we pulled up the closing documents from the sale of the home, the closing documents from when they purchased the home, which proved how much they purchased it for. If there's any renovations that they made to the home, we would gather those documents as well. And then we even pulled up county records from the county to prove that they did in fact live there from this time to this time, okay? And then we also wrote a letter to the IRS stating that we want to challenge these results because of these reasons. The last thing we did is we prepared a Schedule D, which is done on your tax return. So the Schedule D just shows it's a disposition of assets. It shows what you sold. It'll report the sales proceeds and the cost basis and any expenses of sales there. So we also prepared a Schedule D. So all those things were required to respond to this particular CP2000 notice. Now, if you don't have any of those things, you can easily get them, or you can find some way to get those kinds of records. Now, this is specific to a real estate sale CP2000. If you get a CP2000 based on a stock sale or any other reasons, you definitely would have to figure out what they're asking for and what they're trying to get information for. There's a lot of ways that this can go. So if you get a letter, the things that you don't want to do are ignore it, because if you ignore it, the IRS is going to keep sending letters and they might even impose a levy. So if you notice in this letter, it's not finalized yet. It's just a proposal for a change of taxes. But if you ignore the letter and you don't respond, then it's going to become finalized. Then they're going to actually assess the taxes on your accounts. And when they do that, they can start collecting on those taxes if you don't pay or respond. So you never want to just ignore IRS letters, okay? And then the second thing you don't want to do is just wait around. You want to start taking care of this immediately, because they usually give you a time limit to respond. And sometimes they make you respond by mail. You can't really trust how slow the mail is going to be or how quick. So you want to take care of this and get on this right away. So to sum up, the things that you should do is figure out why the IRS is sending you this notice. Okay? Are they disputing your real estate sales, stock sales? Did you forget to report income? Find more information first. If you don't know what you're looking at, then hire a professional to do it. Or if somebody else prepared your tax return, that would be the perfect person to go to for help on this. So start there. And from there, depending on what the problem is, you should be able to figure out what to do specifically. All right, that's all I got for today. Thanks for joining me. If you're new to this channel, please hit that subscribe button. I'd really appreciate it. And if you haven't done so already, please smash the like button if you like the content of this video. And please do share this with your friends, share my channel. I just want to reach as many people as possible and help them through difficult times as much as possible. All right, so I'll see you guys next time and take care.